Hello and welcome to Investing Confidential. Man, what a month. What a last 30 days. It's been absolutely unbelievable. The rally is one of the most violent rallies I've ever seen. Look, guys, it's very simple. People, investors, whoever it is, you guys, everyone is addicted to low rates. Okay. Like a drug addict, completely addicted. We've been, this new age of investors. There's a lot of young people out there who've never experienced a bear market. I mean, they say 2020, when March 2020 was a bear market for a couple of months. That's not a bear market. That's a correction. Not even close to a bear market. In fact, I would say that anyone born after 1980 has never experienced a bear market. Not even close. So animal spirits have taken over. They have just obviously people are banking on rate cuts. Uh, will the Fed cut rates? Nobody knows. The Fed didn't say they're going to cut rates, by the way. I mean, that's all. This is it again. As I said before, this is Wall Street. This is the White House. These are the powers that be that don't want, don't want to see the economy go down. They want to see it only go up. They don't want, they don't want to see ups and downs. And that's the whole point of the business world. You have ups and you have downs. Okay. It's called the business cycle. They don't want the business cycle anymore. And so the fastest way not to have a business cycle is just keep rates at zero. This is what these maniacs want. And I'm not going to go against it. If you're a trader and you caught this rally, wonderful. Would I sell today? No. There's no sign of it. Every indicator is flashing sell, short, get out, get out, get out. But it's been like that for a week. And we're rallying into Christmas, rallying into Friday, and nothing to stop it. I think because most people, nobody knows the strength of it. Most people are expecting a downturn in the economy in 2024. You're probably going to see a massive sell-off on January 1st, given this ridiculous rally. So would I sell today? No. If I was paying attention to indicators, I'd be at 100% cash right now because this makes no sense. It's fun. See, I'm a professional investor. I'm fundamentals. I look at fundamentals for stocks, fundamentals for a market, macro fundamentals. The macro fundamentals are telling you this is a bad situation, a very bad situation we have here. The momentum fundamentals saying this is the greatest market ever. Okay, there's nothing anybody could do. You just keep going up. Every day it goes up. I've seen this before, and it's going to continue probably into the end of the year. There's no look. But I've been saying this for months. There's no liquidity. Okay, it doesn't take much to get these markets up. There's absolutely no liquidity. Okay, but let's look back at some of the things I've been talking about, and I've been telling you guys to buy. And the number one thing that I've been saying for months and months and months is you don't want to, buy this Magnificent Seven. Okay, you want to buy small caps. And here you see the performance of small caps versus the S&P. It's been absolutely off the charts. So if you bought small cap stocks or the IWM index instead of the S&P or any of this, even the Magnificent Seven, you crushed it. You crushed it. You crushed the S&P. Absolutely crushed the S&P, as you can see here. And that was because, as I told you, they were just depressed. And this is the new, and so what we're seeing today, by the way, with these rallies, is these are the leaders. Okay, going forward, whether the market goes up or down doesn't matter anymore. This is where you want to be. Okay, this is where you want to be. And why? What has sparked this incredible move in the indexes? Well, it's very simple. As you can see here, hedge funds, okay, which hedge funds are what they are. As you can see here, there's been a massive movement towards indexes, futures versus single stocks. Okay, what this is looking at is professional investors buying single stocks versus indexes. Historically, well, we can go back many years, but just this year alone, we saw a lot of buying in single stocks and a lot of shorting and selling of indexes. This inflection point, this violent rally we saw after Thanksgiving in the US here, was driven 100% by index buying and futures buying and option buying. This has nothing to do with people buying stocks. This is why it's dangerous, folks. This is why it's very dangerous. And all you got to do is look at Apple. Okay? Okay, here's the chart of Apple, back to all-time highs. And yet, they haven't had good iPhone sales in I don't know, maybe a year. All right, disappointing quarter after quarter. Disappointing sales, disappointing margins. They're moving now from China to India. That's going to affect their margins. That's going to affect their sales. The new iPhone 15 was a bust. It was a bust. The VR and all the headset, a bust. So 2 new products from Apple. And by the way, you can think about this. Since Steve Jobs passed away, these are the new products, folks. Forget about Apple, Apple 11, 12. That's not a new product. This VR headset was the first product. It's a disaster. They keep rolling out another iPhone. Not good. Nobody wants it. The iPhones are great. Look, folks, I own an iPhone. I got an iPad. I got an iMac. Great company, great products. But the stock, $3 trillion market cap, this is insanity. This is insanity. But nobody cares. Nobody cares about fundamentals. And when that happens, you get what I think is the final blowout. This is the final rally we're going to have. This is the final blowout, because there is no way that these Magnificent Seven, okay? And let me tell you something, folks. When I mentioned this before, this is the breadth of the market, okay? As you can see, the Magnificent Seven they've never been the largest percentage of the S&P we've ever seen in the history. Okay, this goes back 40 years in history. This is unprecedented. This is the worst breadth I have ever seen in my investment lifetime. This is the worst breadth anyone has ever seen in their lifetime. Okay? And here's another, again, same thing. S&P top 10 weights as a percentage of all it's mammoth. This is very, very unhealthy. Okay? It goes back to, and again, you got to have historical, perspective, to the Nifty 50 in the 70s. Okay, 50 stocks were the entire market. Everything else went down, 50 stocks went up. And then the inevitable happened. They crashed. And we entered in a real bear market. When those stocks collapsed, the entire market entered a bear market that lasted, almost 10 years, 7 to 10 years. And we're in a very similar situation here, folks. We've got, despite what you're hearing, energy prices are up, and they're going higher, by the way. And I'm going to show you that in a couple of seconds, why this whole CPI thing is a fallacy. But it's a very difficult situation. You have people saying that the consumer is strong, that we have a strong economy, all this. I mean, this is a lot of malarkey, a lot of bunk. And I'm going to show you statistics why it's a bunk. But here we go. Look at this. Nobody cares. The S&P inflows, as you can see here, inflows into the S&P SPY. By the way, folks, this only goes back, 10, 15. This is the highest ever on record. Okay. The animal spirits. It's the animal spirits. Okay. And here we have CTAs. CTAs are commodity players, momentum players. positioning, the highest on record, bullish positioning. I've never seen this before. All CTAs bullish, along with retail, individuals, along with, as you can see here, professional investors. This is a way to track professional investors, meaning mutual funds, etc. So we've got CTAs all-time high bullish. We've got professional investors all-time high bullish. We've got retail investors all-time high bullish. Folks, this is not going to end well. This is a nightmare. For anyone who studies markets, this is a nightmare. Okay, and look, here's what you have here. Here's what here's more bullish. This what the bulls are saying here. You got ISM manufacturing in the pits. That normally is a terrible leading indicator. But no, you've got the markets, cyclical stocks, ripping to the sky. So that means either the economy is going to explode up, PMI is going to reverse, and based on all the forecasts, that's not going to happen. Based on the underlying fundamentals, it's not going to happen. But something's going to happen. Something's going to mean revert, and it's not going to be the PMI. Okay? You know, you look back, one of the most crowded trades around the Thanksgiving time, November, was everyone was long TLT, anticipating this. Folks, I haven't seen an incredibly overcrowded trade break out like this in a very long time. This was a consensus long position, TLT. Everybody was long this thing, and they were all right. So that doesn't happen. I'm going to tell you right now, it just doesn't happen. Right? And the outperformance you're seeing here is unprecedented. Okay, so let's just look at some of the things that you need to focus on here. Here we have small business availability of loans and credit conditions. This is a nightmare. The banks are not lending to small businesses. The credit conditions are as tight as they've ever been. What does that mean? Folks, small business create more jobs than anyone else. This is why we look back at these numbers that have been coming out. I don't care if it's CPI, employment, they're all fake. The underlying statistics are telling you, and I told you before, they're unreliable numbers. They're completely unreliable, but everyone's trading on them. Everybody. And then you have here, bankruptcy filings. We got a booming economy, right? Okay, that's what everyone's telling us. We got a booming economy. We got strong consumer. Small businesses falling off a cliff, and they're filing for bankruptcy. The highest we've seen going to 2010. How does this make any sense? How do you buy stocks in this? Again, I go back to everyone is addicted like a drug addict to lower rates. Nothing else matters but lower rates, the pivot, the Fed pivot. The Fed really hasn't pivoted. The Fed stopped raising rates. It really hasn't pivoted, though. Okay, and then when you look at, again, going to what else has been driving retail? Everyone's on retail sales, folks. The job numbers tell you, the payroll numbers tell you something completely different. How is retail sales going through the roof when they're firing people in the retail industry? This is what this is telling you. People getting fired into the Christmas. Usually see the complete opposite seasonality wise. Hiring. Nope, firing. Makes no sense. Non-farm payrolls. Where is it? Look, everyone's bullish. You know what? You take out healthcare, you take out leisure and hospitality, low-paying jobs, and you got The non-farm payroll was very weak, and it's continuing to trend lower. But the bulls told you something different the last couple of weeks. They're not giving you these statistics. They don't want you to see this. But that's the reality. So animal spirits taking over. The markets continue to go higher. Where they stop, nobody knows. We're going to rally into the end of the year, most likely. Nothing makes sense. But you have to position somewhere. You have to set yourself up somewhere. And what I showed you before about small caps, that's where you got to be. Forget the S&P. You got to be in small caps. When everything goes down, they're going to get walloped. But if you want to have outperformance over a long period of time, you got to be in small cap stocks. And then we have the other thing that I mentioned a couple of months ago that's now something you really need to watch, which is the US dollar. Okay, here you see the US dollar is getting crushed, folks. End of story. It's over for the strong dollar. And as I told you, what is the danger of the weak dollar? Weak dollar, the strong dollar covers up a lot of nonsense that these governments do. But when the dollar becomes weak, okay, you're going to see a couple of things happen. Number one, the most important thing you're going to see is commodity prices. Remember, commodity prices are priced in dollars. And if the dollar is going down, commodities usually rally. And when it's all said and done, the CPI, I'm not going to go through the analyze because it really doesn't matter anymore. It's been weeks already. It was really just oil. As you can see here, this is a 5-year chart of West Texas Intermediate WTI. We spiked. We just came down to the 200-day moving average. We're going back up again. The trend is higher. And what do you think that's going to do to CPI? And here's another reason. We look at this moronic government we have. These guys are morons. By the way, the Strategic Petroleum Reserve is still at the lows. It's still the most depleted it's ever been. The most depleted it's ever been. And these guys come out publicly about a week and a half ago. It says, we're going to buy 3 million barrels of oil. You can't make this stuff up. You can't make this stuff up. These guys are morons. Our government, the U.S. government, is being run by morons. Okay, so you're going to see commodity prices like energy, like other things going up, corn, sugar, they're all going to start to creep up again. Now, will it hit the CPI? Well, the CPI is manipulated, so I have no idea. But it's going to creep up again. And as I told you, this inflation is sticky. Despite all the stuff you've been hearing, it's still very, very sticky. Okay, so what to do? Small caps, and then with lower dollar, which you got to look at, is emerging markets. And I think I'm going to focus on that for probably the next 6 months, as I did with Argentina, as you know. And by the way, as you can see here, if you bought emerging markets, especially Argentina, when I put that video out, you made a fortune, folks. You blew it out. Even if you missed the first couple of days, you blew it out. Still going up. So I'm going to focus on that because that emerging markets are setting up for one of these 5 to 7 year outperformance, and you're going to make a lot of money in these countries versus what you might make in just the S&P, which is incredibly overvalued. And one final thing about the dollar and emerging markets is here. I mean, nobody is really paying attention to this, but our friends in China, they've got consumer deflation. This is the worst case. And to me, folks, this is where the entire world is headed. China is going to start exporting this consumer deflation. Their economy is in the pits. they're in the beginnings of a very long downturn like we saw in Japan. 30 years, Japan was in a bear market. China's headed for that. The days of China overtaking the US and GDP, those days are over. Those days are over. Now, will the market recover? Probably soon, yeah. Probably January 1st, one of the markets that people are going to pile into because of the massive underperformance is China. So if you want to make some money on December 30th, 29th, 30th, right before the first, buy FXI. Buy FXI and short the S&P or just buy FXA outright. Okay, and again, I'm going to show you here. This is a similar chart of what I showed you with the small caps. U.S. equities versus emerging market equities. We are at 50-year lows. And if you look, interesting enough, the last time we saw a massive outperformance versus was in the 70s, before the 80s. But we saw the lows come in, and here we go. So EEM, EWZ, which is the Brazil ETF. I'm going to start focusing on all these countries, country by country, because they're all unique, and they're going to give you big outperformance. So look, animal spirits, market's going higher. I don't buy it. I don't own it. I own gold. Gold's done extremely well. I own small caps, emerging markets, which is my specialty. That's where you got to be. But I mean, the S&P, the Dow, one thing I can tell you, it's shocking I think it's shocking this rally surprised everybody. Professionals, individuals, and everyone is jumping on everyone is bullish. Folks, options at all-time high call buying. I showed you the CTAs. I showed you the professionals. So everybody is bullish. And as we spoke about in the past, when everyone is positioned bullish, you got to go the opposite way. You got to go the opposite way. But it's been tough because it's been like this indicator's been like this for over a week. And it continues to go up and up and up. But you definitely need to go the opposite way. So if you're an investor out there, I hope you're enjoying the ride. But first of the year, be careful out there.